Capital generally flows between two assets, equity and fixed income. Equity, think of the stock market, the S&P 500. Basically, stock means that you have shares inside a company and you take a risk on that company. That means if the company fails, you lose your money, but if they win and success to IPO and things like that, you make big money. On the other side, you have fixed income, and fixed income is basically debt instruments. So things like loans, bonds, and mortgages. The interesting part is when central banks raise interest rates. So when they do that, you have the flow of money that is more oriented now toward the fixed income because now you have what? You have better yields and low risk. That means if you buy, for example, a treasury bond from the government, you will have better return on that, but also low risk because there's low chances that the government will default on your debt. But that also implies when those interests are high, that the expected earnings of the different companies where you have shares in will be discounted because money is now expensive, and that implies generally that the value or the price of the stock of the company will go down.